when I look at the size of these companies, Apple and Tesla, and I just can't wrap my head around like big monster moves. Like somebody was saying Tesla's in the first inning, and I was like, first inning? Look at the look at the monthly chart. The stock's up like 27 million fold, you know? Okay, so it's in the second inning, maybe, but there's no way it's in the first inning, you know? It's there's an economies of scale to this for sure. That's why, you know, there's the S in Can Slim. We don't talk about it much anymore because the big stocks have done really, really well in the last, you know, 10, 12, 15 years. But there's a reason there's an S in that acronym.
You're going to have to explain it for those who don't.
Well, the S it used to it used to mean
in the first and second edition, it was shares outstanding.
Exactly.
Yeah.
The S was shares outstanding. You wanted to buy
32 million shares outstanding or less.
So you wouldn't be able to buy anything if you picked up How to Make Money in Stocks today. You just came back from the moon or something, and you read it. You'd be like, and you pulled up these stocks, you'd never buy a stock.
Mm-hmm.
So you know the markets change obviously, and
Right.
this is we always would say, boy, I really wish, or we would think out loud, you know, me and Arusha and guys like, what if Bill wrote the book today? What would be different? And I think that the size of the companies would be something that he would address. And then earnings reports. I think he'd have to address the idea of the risk around earnings reports being much greater than it used to be.
So but he did address the
owned.
size. You know, he did address the size because in the third edition,
he went to supply demand.
Supply and demand was what the S stood for instead of shares outstanding. And
exactly.
you know, this kind of came you know, top of mind to me because when I first started, it was 97, and that's when, you know, the Red Book was out, second edition, shares outstanding, 32 million. And I, you know, I came in to work. And I did own some Ford stock that I had inherited from my great grandmother. She was a seamstress at Ford and for many, many years. And, you know, despite being a modest means, she actually had like a ton of Ford stock. You know, and so I had $2,000 worth basically, you know, but I was a great grandchild. The grandchildren got more and the children got, you know, more. So there was enough to go around. But you know, Ford, of course, was not 32 million shares outstanding, you know, back in 97. So I immediately read the book. After reading the book, I sold it, you know, and then it was, you know, later on when I first met Mike Webster and we were, you know, sharing a room in Philadelphia, because back then when you traveled for the company, you shared a room. So, you know, Mike and I are. Yes, exactly. Mike and I are sharing a room. That's how we met. You know, we shared a room in Philadelphia, and you know, I was talking about
how the movie Planes, Trains, and Automobiles
exactly.
was loosely based on that, on your experiences. Sorry, I couldn't help myself.
But Mike was, you know, telling me, oh yeah, Ford was coming out of a, you know, great, you know, a great base back in 97, and we had it on our, you know, NESME list, you know, and I'm like, oh. Wait, what book are you going off of? You know? So yeah, Bill had kind of changed his mind, recognizing that, you know, a lot of the big caps in, you know, the way he explained it was with the mutual fund institutions, you know, the 401ks, all of these just increasing so much incredibly in their size, that their, you know, that institutional sponsorship became so much more important. And it kind of, you know, trumped the shares outstanding.
Great. And then the other thing too is, you know, people will ask us like, well, Bill said we should own a maximum of 5 stocks. And that, hey, that was before the situation with commissions changed, right?
Yeah. Now, you know, I think he would still argue that,
for concentration,
you know, for concentration,
right?
But
especially in strong markets,
you know, in the aughts, there was, and look, you know, part of it too was he got older, you know, his, you know, after the 90s, you know, he had an order of magnitude increase in the size of the portfolio. And so it was a lot more money that was being run, especially after, you know, 2003 too, because they had kept most of the money, right? Instead of giving away a lot of that in the .com crash, they had kept a lot. So, you know, a 1,400%, if I remember correctly, it was about 1,400% over, you know, a few years at the end of the 90s, you know, and through 2002. So, you know, he was dealing with more money. And I remember Wendy Wright was one of the portfolio managers, and she had a lot more stocks. I think she had maybe like 15, you know, stocks. And instead of, you know, poo-pooing it and saying, you know, what are you doing, Wendy? You're not following my rules. He noticed that, you know, she was still doing okay. And so he was open to it. You know, hey, you know, in this market, Wendy's got 15 stocks, and I saw him gravitate to more stocks. Now, he would eventually, a lot of times, start narrowing it down, you know, picking off the losers and laggards and, you know, put more money into the winners. But, you know, as he got older, you know, I saw him go from the, you know, owning Corning, you know, or, you know, being split on margin between Apple and Google. You know, there was one time where those were his two stocks. He was fully on margin, and that was all he owned, those two stocks.
Right.
But later on, that's just not the way he traded as much. He had more, and he, you know, he wasn't concentrating nearly as aggressively.